Welcome back. Now we will discuss, we will identify how to practically develop a statement of financial position, which is also known as a balance sheet. Now, when we are developing a statement of financial position, the first thing that you have to remember once again is that it's again a part of accounting equation. That means assets should be equal to capital, that means equity, plus liabilities. So look at the trial balance given here. That means after balancing all the accounts, you have cash account, debit balance of 2000, inventory account, go to the table, inventory account, debit balance of 500, capital account, a credit balance of 2000, liabilities account, credit balance of 500. So if you are maintaining double entry accounting system, the trial balance should be balancing out. So total is 2500. So when you put them into your balance sheet, that means statement of financial position, it looks like the balance sheet which is given in the bottom of the page. Look at the example. So assets, total assets 2500, that means you have two current types of current assets, cash 2000 and inventories, which is again an asset, 500. So it totals out at 2500. Then it is being financed by the other side, liabilities 500 and total equity, that means the capital of 2000. So it is balancing out at 2500. Generally, once again I am repeating, balance sheet, statement of financial position should be balancing out because it is using the double entry accounting system. So total assets should be equal to equity plus liabilities. Then in the financial statement set, the other statement of changes in equity. Statement of changes in equity discusses shareholder contributions, otherwise owner's contribution, shareholder or owner's contribution to the business. This shareholder contribution or owner's contribution can come from cash or sometimes through different assets like motor vehicles or land and buildings. Kind of shareholders can put either money or either their vehicles or either their land and buildings to the business. So that interest, that funding should be represented in their balance sheet, in the statement of financial position. In addition to that, it should be shown in a separate statement known as statement of changes in equity, how the capital and equity changed during the year. So statement of changes in equity may come from different kind of sources. The changes can come from different kind of sources. From shareholders contributing more money through share purchase, new share capital. So when new share capital comes, equity will go up. Or through profit making activities, retained profit goes up and retained earnings go up. Or if a property is revalued, that revaluation surplus, revaluation reserve, revaluation profit is the profit of the shareholders. So it will also move up the equity value of the shareholders. So statement of changes in equity shows the impact of changes in equity on the shareholders' net worth. Now, after learning about the statement of financial position and the statement of changes in equity, now it's time to learn on the income statement. Our income statement is the statement which will analyze the past financial performance of the business, ideally for a 1 year period. Generally, income statements are prepared for 1 year period. In good old days, this income statement was known as the profit and loss account. That means it's the difference between income and expenditure. So income statement will evaluate what's the profit or loss earned by the business for the given period. So it shows the revenue and the expenditure. So revenue minus expenditure is the profit. This is the format of the income statement. Typical format, the first line, normally we call it the top line. Top line of the income statement is the revenue or sales, or sometimes we call it as turnover. Then less, you deduct the cost of sales. That means the cost of the goods that you have purchased. So revenue less minus the cost of the goods that you have purchased, you will get the gross profit. Then minus from that all the expenditure. Sometimes we call this as overhead expenditure. So that's the net profit. So revenue minus cost of sales will be the gross profit, less all other expenditure is the net profit. So income minus expenditure equals profit. Once again, the income minus expenditure is the profit. Now look at the example we have given here. Joe Soaps runs a fish and chip shops. He recorded the following transactions for the year end. For the year ended 31st December 2014. Sales of fish and chips 25,000. Purchase of fish and chips 15,000. Cost of cooking oil, rental of the shop, electricity and other expenses, and wages. The figures are given. So from this, prepare a profit and loss account. So how do you prepare it? First of all, get the top line, sales 25,000. Then minus cost of the goods sold. So purchase of fish minus 15,000 minus cooking oil 1,000. Then you will get the gross profit. So from that, reduce all other expenditure. That means rental of the shop, electricity and other expenditure as well as wages. So then you will get the profit and loss of the business. So now here you will get an example of a typical income statement. Income statement under International Accounting Standard number 1. Revenue is there, cost of sales given, minus gross profit 40,000, then other income plus 2,000, distribution cost minus, administration cost minus, other expenditure minus, finance cost, profit before tax, then you will get the profit for the year. So if you can remember, in the statement of financial position or balance sheet, it goes with the formula assets equals capital plus liabilities. Here in the income statement, it is revenue, sales minus expenditure is profit. Very simple. And the statement of changes in equity, if there is a balance of equity of 500,000, that profit for the year 12,000 in the figure in the particular income statement will be added. Because of the profit, the owner's equity, owner's capital will go up by 12,000, and minus dividends. If you have declared dividends, equity will go down. Then final statement of changes in equity balance is 507,000. It's a very simple example that we have done. So income, revenue minus all the expenditure is your income statement. So whatever the profit will add to the equity, owner's capital in the statement of changes in equity, or if it is a loss, it will reduce the equity value. Now we will look at the income statement of a trading company. Now a trading company means a company which buys and sells goods. without any process. So in that kind of a company, the revenue is the top line. Then you will have the cost of the goods sold. So sales, the revenue minus cost of the goods sold will be the gross profit. Then from that, you have to get the operating profit. So for operating profit, you have to reduce all other expenditures like salaries, the wages, things like that. So then you will get the profit before taxation. That's the part 3. Then you deduct the taxation, the value of tax. Then you will get the profit or the amount attributable to the shareholders. So part 1 will be the calculation of gross profit by deducting cost of goods sold from the revenue, from the sales. So from the gross profit, then part 2, you deduct all the expenditure like administration expenditure, then sales related distribution expenditure, deduct all. Then you get the net profit before taxation. So from that, reduce all the tax values. So you will get the profit attributable to the shareholders. Preparing a simple set of published accounts. We are now going to prepare a simple set of accounts. Simple set of accounts for a small scale organization. This is just to underpin what you have learned so far about account classification, jargons, layout, the formats, and show you some simple account adjustments. Don't worry, you don't have to do this on the assignment, just interpret it. Now we will look at it. Preparation of financial statements. Each transaction will be in double entry format. That is, keeping accounting equation in balance. You know, each transaction have two sides in it. A debit side will be debit entry, will be increase of expenditure, increase of assets or drawings, or decrease of liabilities, income or capital. A credit entry will be increase of liabilities, income or capital, and decrease of expenses, assets and drawings. So we can now go on, which we learned profit and loss account is income minus expenditure equals profit. You know the format of profit and loss account. Profit is income minus expenditure is profit. So you start with the top line revenue, then cost of goods sold, then you will get the gross profit, then minus all the expenditure, then you will get the profit to the shareholders. Then the balance sheet will be, as we understood, asset side should be equal to the capital plus liabilities. Now what I need all of you, from this information, you all need to prepare a draft set of accounts and provide it for me to mark it. Look at the question. What you have to do is prepare from these the draft set of income statement as well as the statement of financial position using the equations I gave you and putting the figures into the format. Look at the requirement. Required, prepare the statement of financial position as at 31st December 2014 and the statement of comprehensive income for the year ended 31st December 2014. You should start by identifying which financial statement each item in the trial balance should appear in. You may then find the template on the following pages which is helpful for you. Now this is the trial balance. What I want you to do, put these figures into the income statement as well as what? As well as to the statement of financial position, and ultimately the statement of financial position should be balanced because this is double entry. Trial balance is balanced where debit side and credit side both sides got 3637 and whatever the statement of financial position, the balance sheet which you are preparing should also be balanced. Right? And I need you to prepare this. and send me for marking. I will mark that for you and I will return that with my comments. Another question. The following extract from the trial balance of B Limited have been provided. Prepare a statement of financial position from this. So I need the asset side on top, then equity plus liabilities on the second. So from this, prepare the statement of financial position. From this, I need you to prepare an income statement. So with this particular lesson is over. I need all of you to prepare your answers for these questions and submit me for marking.